evening, everybody. We are live here on the YouTube and excited to be out here tonight. This is Coach D here with TackleTrading.com. We've been putting together this Wednesday night live YouTube series for your benefit, just talking shop, just kind of getting together, looking for a good time tonight. Waiting for folks to trickle in here. It usually takes a minute for folks to trickle in, and I kind of try to keep an eye on my YouTube channel so I can see who's coming in. Say hello, kind of, give everybody a shout out as they come in. And what we're going to be talking about tonight, we're going to be talking about covered calls and, relatively conservative investment strategy, generating cash flow, allows you to neutralize your positions a little bit, benefit regardless of market conditions, up, down, or sideways. And if you are experienced at all with covered calls, I mean, you know what a great strategy it can be for compounding those gains long term. But when you get into a more volatile market or a market that moves more, either up or down, we need to typically adapt that strategy to help us, do better with it in market conditions. So as we go live here, just want to make sure we see folks trickling in. There we are, coming on in. Just trying to get a feel for who's here. We already got a couple of thumbs up, and we got, hey Ahmed, how you doing? Dennis, Damon, Linda, a lot of regulars here. Fantastic. Glad to see everybody coming out. And of course, as always, you see our disclaimer here. Again, we're not here to give you direct trading or investment advice. That's not what we do. We're here for educational purposes only. We're here to talk shop and help you think better, become more proactive about your trading, just better education, better knowledge base. You'll be able to make better decisions when you have more information in your arsenal. So let's go ahead and kill the old disclaimer there. That's always fun to bring up. And just talk a little bit about the market for a moment here. We saw some bullish activity in the market. And we were talking today, we got together, we had the traders lounge this morning. We were in the halftime report. You got all your market analysis and review. It looks like the market gave back some of those gains today by the close. We actually saw it pop up nice and then come back down and close. Then in our after hours trading, we're seeing prices start to move back up to the upside again. So, hey, Sess, how you doing? Glad to see you here. Grant, we got quite a good group forming here. Glad to have everybody out. And again, I just want to congratulate y'all on being here. I know you could possibly be doing other things. And it just tells me a lot about your dedication that you guys show up for this stuff. That's awesome. Again, we're trying to get the word out. So give it a like, give it a smash that like button. So, share it with folks, put it out there on social media for us so we can get the word spread. We're consistently growing our audience week in and week out. Pretty steady clip. And again, excited. So Try asks, what do they call that candle, Coach? That's a great question. You're talking about this here last candle in the market. I don't know if you have a real specific name for it. It's kind of a high wave candle with long shadows on the top, long shadows on the bottom. It's got a bit of a body to it, so you might consider it kind of spinning top. In this case, I'd say with the way it came down and tested support and then actually broke out to new highs. What I would always do in this case, if I want to get better insight into it, I just break it down into a smaller time frame and look at that down on like a 30-minute chart, maybe an hour chart. So you can see how it played out. And really what that candle tells me is what I see right here. Prices dropped overnight into the open, rallied all day, sold off at the close. And then we saw a higher low come in and we're starting to see them move back up in overnight trading. So I would dare say that we actually had a kind of a breakout and it gave up that ground. So it kind of popped its head up, got some bulls going into the market, and then you saw some selling off late in the day. And that's not atypical for a good day like today. We had some good bullish market activity, just some profit taking. We'll kind of have to see how that plays out. But the higher low, I think, favors the bears in that case. So, high wave candle is probably what I would call it. But anytime I have a question about what I'm seeing on the candlestick, I always find one of the better answers is taking it down a time frame. Now, that's kind of a shorter term trader's perspective and not necessarily what we're here to talk about tonight. I have a basic agenda for us tonight. I want to talk about covered calls. I know you all have used this strategy, and it's, when I first started learning covered calls, I found them extremely boring. How about you? Do you find them exciting? If you like your covered calls and you find them exciting, I want you to type excitement into the chat. And if you find them kind of boring and kind of like watching paint dry, sometimes I want you to put in. They get exciting occasionally, but you could put boring in the chat. Just kind of give me an idea of what you guys think and feel about the covered calls. And I've always, perceived the covered call as just kind of a slow and steady wins the race. It's not, kind of racing with the rabbit. It's more of a tortoise type strategy, but the goal is to cash flow and compound. I got Z's. I didn't tell you to type in Z's guitar flip, but I'll take it. Yeah. Well, no, I thought it was for old people. Well, and I've kind of done a 180. When I first started studying covered calls and understanding it and starting to use them, the thing that really got me was the difference between like a covered call and a spread trade. And the capital intensive nature of a covered call versus a credit spread or something like that, just like a bull put credit, you could get similar cash flow with less capital outlay. And we could technically apply the same lessons we're going to talk about tonight to even those credit spreads. But if you've got to have a longer term perspective. If I had a time machine and I could go back in time and talk to myself as a younger trader and investor, I would tell myself not to poo-poo the idea of the covered call, not to poo-poo the idea of buy and hold, like longer term perspective. And because I had a very short term perspective, wanted instant gratification, wanted cash flow money now, again, if I could go back in time, I'd say, look, buy and hold these assets and learn to write covered calls around it. Because over time, what's going to happen to the prices of these paper assets? And I think you guys know the answer to this. I mean, you'll have bull markets, you'll have bear markets, but over time, which way is the market going to go? Which way are these assets going to go? Or another question could be, which way is the value of the dollar going to go? So I think we know we can answer that. We can know that over time it's going to go up. So you want to have that long-term, I would call it kind of economic force of nature working for you. And covered calls are great when the market is neutral, but they can also be really, really effective when the market's even going higher. And that's one of the things we're going to talk about. We're going to take the idea of, what we would typically teach in like a covered call strategy where we, buy the asset, sell a delta. What's your delta rule, by the way, when you're going to sell that covered call? I know we've all taken similar type training and education. We've learned, I'm going to sell a delta around 40, or I'm going to sell a delta in that ballpark of 30. What's your delta rule? If you're writing covered calls, you probably have a delta rule. What is it? Go ahead and type it into the chat for me just so I can see that. And it takes a minute. There's always a little bit of a lag between me and the YouTube live feed. So I just 30, 40. Okay. I'm kind of in that same ballpark traditionally. So what we can talk about is, well, a couple things you can do. You can write those covered calls with lower delta. Bull call diagonal is another way to go. Another great option for you, Ahmed. And could you apply the same concept to the bull call diagonal? Of course you can. And then I would imagine if you're like me, we're liking the bull market activity. I think we're all on board for higher price movements, but we probably have a reasonable shadow of a doubt rolling around there in our brains that there's a potential downside risk here. Hey, Scott, glad to see you here. Yeah, I would imagine we got some downside risk. I'm going to talk about rolling up. We're going to talk about, well, hey, can you roll down? You bet you can. And then how to also, you can get defensive with those calls. So I really like the covered calls for a couple of reasons. It's probably one of the more forgiving strategies out there. And if I could only teach one strategy to folks out there, it would be kind of adaptive covered calls. It would be like, look, learn how to buy assets that you like, learn how to buy something you want. a company that has, good fundamentals, good growth potential. You can do this kind of thing in your retirement account. And then you can roll those options when you're looking to extend those capital gains. You can roll them up, roll them down. Now, again, you can apply a lot of the same lessons to things like diagonals and even things like credit spreads. But it's a way for us to participate and not have to get overly worked up on trying to time the market day in and day out. And the longer and longer I trade, the more challenging I perceive just going about market timing. Like the average person who tries to go out and start day trading, swing trading. I mean, certainly those are viable skill sets that people use and they can get really, really good at. But at the same point in time, day trading is kind of a job. You have to sit in front of your computer, and depending on what kind of a system you're using, you could be sitting there all day. You could be doing it just a couple hours in the morning type of thing. But if you're looking for that long-term growth, the type of thing where you can set yourself up for retirement, you can leave generational wealth for your kids, buying good assets is never a bad idea. And if you can pick up those stocks that have the dividends, that's always a nice thing. Get a little dividend. I mean, dividends are boring, covered calls are boring, but a good investment, system, a good investment strategy can be boring. It really should be boring. And you can really kind of get rid of some of that psychology, the challenges that come into trying to time the markets all the time. So one of the reasons I like the covered call is just it's somewhat forgiving. You can mistime things from time to time. It's not a deal breaker. Worst case scenario, you get called out. Stock prices drop. You'll still own the asset. You can still write covered calls. You can still continue to lower your cost base and cash flow. And over time, if you're picking the right kinds of companies, it'll go up. Yeah, it is. And, it is boring. And if done right, it shouldn't be that time consuming. So I got a couple of stock lists here. And again, the reason we're doing these Wednesday, webinars, we are just trying to get the word out, trying to get our YouTube, footprint a little bit larger so we can get more reach out there. So again, if you can think of somebody that could benefit from a little lesson on investing in covered calls, again, don't be afraid to share that out there. And we'll be making a little offer at the end for folks who are new to us to join Tackle Trading, just kind of get to know our community, get to hang out with all of these awesome folks here. Again, a couple names I don't recognize that I'm not familiar with, but see some of our old favorites in there, of course. Hey, Grant. Hey, Blake. Hey, Randy. And if I missed your name, it's just because I can't pronounce it perhaps, or I didn't see it, but glad to have everybody out here. So I've got a couple stock lists prepared, and you guys are probably familiar with these little lists. I got my Tackle 25 list. I got my Poor Boy Covered Call list, and I got my Dirty Sexy Money list from 2020. And I've got a couple of other stocks maybe in mind, and I'm certainly happy to throw out, some of the ideas if you guys have ideas of what you'd be like to talk about. But we can just talk about how to go about it. So I'm going to start out with our Tackle 25 list, which is, again, it's designed for cash flow type strategies. This list was put together with long-term investment in mind, kind of looking for strength, looking for fundamental strength, looking for companies with decent balance sheets. We're looking for companies that also have very tradable options so we can do things like our boomerang trade. Now, for those of you who aren't familiar with the boomerang trade, it's just where you take the idea of selling a put, a naked put or a cash secured put in a retirement account or even a margin account, doesn't really matter, but where you can get paid to buy the asset. Once you own the asset, you can turn around and write covered calls. If you get called out, you can go back to selling your puts to reacquire the asset and kind of work around a cash flow cycle and really make that compounding gain your goal. Now, we're going to take a look at this list real quick here and see if we find something that really speaks to us at the moment. I'm already interested in Apple. It's hard not to like Apple. When I look at the weekly chart on Apple, we got that little pullback into the bull area between the rising 9-period weekly average and the 20 weekly average. Deep pullback, upward movement in price. Tech sector strength has been obvious. Apple, obviously, company people don't mind owning. They had their recent stock split, which brought the price of Apple down, making it much more accessible to people. And they also pay that dividend. So you got a dividend paying stock. And I think this would be a great place to start. We've got a good little technical pattern with a little double bottom and a breakout back up above the moving averages. And again, at a $115 cost base. Now, when I go into that, okay, I want to own this asset mindset, I always want to have a longer fundamental perspective. And I want to make sure I'm picking stocks that are plenty liquid, that have, lots of options to trade, easy to buy and sell options around a core stock position. And so that's what we would like to see. So we'll talk about Apple here for a minute. How do you resolve this is a great question from Randy Regulacion. How do you resolve competing psychologies of boredom and cash flow? Have a margin account that you can play with, Randy, and have a long-term account that you can be bored with. That's how you do it. You wear two hats. You let your alter egos not battle it out, but just have their own play areas. Does that make sense? That's probably how I would recommend approaching it anyway, is just go in and say, look, have an IRA account, have a longer term account. And with that account, be boring, be measured, be consistent. And to keep that itchy trader finger and compulsive, I don't know what you call it, return, we want to get those compulsive returns out there. Oh, it just occurred to me, I don't have my video. I might as well turn on my video while I'm talking to you. Let y'all see my bright and shiny face. Sorry about that. Didn't mean to have that off. But I think you can also satiate your desire to trade and have some excitement in your life just by having a shorter term account. And then also, might I suggest like some sort of hobby that gets your adrenaline going, that can help compensate, so you don't start just thrill seeking in the market. Because I've done that before, where I've been, kind of bored, a house cat, and the excitement of my life would come from the market. And if you're getting your heart racing from the market action, well, then, that you might have a problem. You might have a problem. Whoops, I don't need that. Okay. So let's talk shop. So if you were to go in and acquire Apple, I wouldn't have a problem buying Apple at the current price level. One, I mean, it's a good price. Again, with their split, it certainly dilutes the number of shares, but it also brings that price down much more accessible. And if you wanted to own Apple, you can do that. And again, this is not an advertisement to buy or sell Apple, nor is it to be considered or misconstrued as advice. But if you could get your hands on a stock that has got some fundamental strength, whether it's like an Apple or a Microsoft or any other tech stock you want to own, that would be great. So we're going to talk about Apple because I just know it's got liquidity. I know it's got some of the things we're looking for. So if we're looking at that, and one of the things I'm always going to look for is just number of options, liquidity of options. If they got weekly options, that's always nice. And one of the things that I always look for is usually somewhere between a 30 to 60 day expiration date, for somewhere in that ballpark for the covered calls, for the naked puts. Now, you could start the investment out just by buying the stock straight out. Absolutely nothing wrong with that. If you wanted to go the naked put route to acquire it, you can certainly do that. Have them pay you to get into the position. That's always a good idea. So you can always go that route. Now, once you own the asset, you can write the covered calls. Now, if I have a strong sense of timing, which is one of the reasons we use technical analysis, in my opinion, is you actually want to go in and try to improve your timing on entry and exit. Wait for a breakout, wait for a good technical setup that can give you a better sense of timing. And then, if you get it right, you might get a nice little capital gains out of the gate. But if you get it wrong, so what? Start writing covered calls. It's an asset you wanted to own anyway. So that's one of our core rules is you only do this stuff on assets you want to own anyway. It's always a good idea to pick up an asset that you can afford, that you want to own, that you think has long-term strength and fundamental sound. And then also, maybe one that pays a dividend. Dividends are better than a kick in the shin. They're not super exciting, but over time, if you could collect an extra 3% a year just on a dividend, an extra 4% a year, an extra, 2.5% a year, it doesn't really matter how big. If you can get that consistent little drop in the bucket quarter in and quarter out, that compounds over time. Now, as you go into that options chain, and in this case, I'd probably be looking to trade a little less. So I'd be okay doing a slightly longer term option. Maybe I'm willing to go out to November. And you can do the 30-day option. You can do the weekly options if you want. But one of the things I've always found is when you go to write your covered call, if you're using short-term options, it's going to put your strike price closer to the current stock price. And if the market rips up or moves in that direction, your odds of getting called out go up. So I always like going somewhere between about 30 to 60 days so that I can put my sell order out there, the strike price I choose, at a lower probability of getting called out and still generate a little cash flow, still generate a little compound interest. So in the case of Apple, one of the things I look at is, okay, I understand the stock price. I understand where support and resistance are. I can look at some of the key price levels out there. Like it's okay, we got support down here at 103, 104. We got the $100 price barrier down there, could be support. And then the next down below that, 90. So I think your downside risk right now is about 104, 190. Near term, you got the 200 period moving average creeping up there. By the time it gets down there, it would be somewhere in that 90 ballpark. To the upside on resistance, you probably have a little support resistance out there at 120, 130, maybe 137 at resistance. And I always like to look at a chart of implied volatility, which is a nice little way to get an idea of, are these options expensive or cheap? I like to use a probability cone. If you don't know what a probability cone is, it's an easy thing to figure out. It basically just gives you a probability of where the price is likely to be within based off of the current measure of volatility. So if right now I'm going out to a November option, for example, and those options expire on November 20th, when I go look at my chart, I can say, okay, well, hey, those options expire on November 20th. I've got two probability cones on my chart. A 68% probability model that says odds are it'll be below 136. That coincides pretty close to resistance. I also put on an 80% probability model, which says, hey, odds are it'll be below 143 based off of that current volatility measure. And again, to put that, this is a standard study in a lot of platforms. I learned about this many, many, many years ago from a guy named Don Fishback. I learned about probability cones on a VHS tape. That tells you about how old I am and how long I've been trading. I think I still have that VHS tape. I just don't think I have a VCR anywhere. But that's where I learned about probability cones and standard deviations and how that stuff works with options. And I like the idea of putting that on there. So that's called the probability of expiring cone. And the default setting on that's a 68% probability model. And if you want to add a second one, you can just change the number to 80%. And that way you can get, a higher probability model. The next thing I always look at when I'm going to consider that is I want to know what the market's pricing in on that implied volatility. So when I look at the implied volatility indicator, and this is a little custom built indicator Tyler put together. And if you'd like to get your hands on it, just come hang out with us over at Tackle Trading, get into our clubhouse, hang out with us in the Traders Lounge. We can always get you this little custom indicator. But it's telling me right now they're pricing in 48% implied volatility. And what that means is they're forecasting out a 48% price swing over the next year. So 48% price swing. And that's a big price swing. And the way that this little indicator works is, hey, green would mean that the options are, affordable. Red would mean the options are out of sight, and yellow would mean the options are expensive. They're not outrageously high, but they're expensive. So right now there's option premium built in. Earnings is coming, so I suspect that the premiums are going to get a little higher. So you may wait to try to sell that covered call. But I usually would try to sell outside that probability cone. So if I'm going to go longer term for November, out here November 20th, or if I'm going to go 30 days, somewhere here near the end of October, then I could probably use a lower strike price. And you can certainly do that as well. But I'm starting my thought process out before I even get to the strike price selection. I'm trying to figure out what the market's pricing into the volatility. And again, what we're talking about here is how to write covered calls in a volatile market. Now, again, do you guys have any idea where the market's going to be by November? I mean, especially November 20th. It's a big question. I think the next, how many days do we have left till the election? Not enough. Or not, or too few. I don't know what your perspective is on that, but there's some uncertainty out there in the market. And even though I think the market's relatively apolitical, I think that the potential for volatility is there. I normally expect fourth quarter bullishness. That doesn't happen every year, but it happens more years than it does not. And I have no clue where the market's going to be either. That's why I'm starting out with the probability model, because the market, I don't think the market knows either, because the market makes decisions in real time. And just looking at that probability model would be like, okay, if I can get out above 143 or 136 out in that ballpark when I'm considering selling a covered call, I'm not going to get a big fat premium, but I can get a little premium and have a high probability of not getting called out. Well, we're going to talk about that. Nobody wants to lose between now and November either, but I still want to be doing something. And it's probably okay to sit a little bit on the sideline. I'm more in cash at the moment than I am in positions, but I still have core positions that I'm holding and things that I'm trying to manage. And I've got a couple Band-Aids. I'm still figuring out where I need to rip them off, et cetera, how to mitigate losses. So just like you, I'm as concerned about where the market's going. And because I don't know the answer, that's why we're talking about how to go about still generating some cash flow without overexposing yourself to getting called out. Because one of my greatest frustrations with the covered call, and probably yours as well, is just getting called out. Getting called out is a weird kind of a bummer because you won, but you left a bunch of money on the table. And when you have to roll your calls up, if you wait too long, it kind of becomes pointless because you end up taking a big drawdown on the calls, and then you might make a little bit more. But it's one of those things that's just kind of weird psychology that goes along with that. Winning, but not making a max gain, or capping your gains is one of those challenges. So let's take a look at the contracts. Again, you could choose short term or long term. When I go out to November, I notice that they're pricing in plus or minus $17.73. And they've got 50% implied volatility on average for the month of November. So they're pricing in 1773. Let's call it $18 to make the math easier. And let's round this up to 116 ballpark just to make the math easier. So what's 116 plus 18 points? Just to kind of round that up. We got 116 price ballpark and about 18 points being priced in on the options. And you could do this with the puts too, of course, Neil. You can sell the puts if you're looking to take assignment. Not a problem at all. Always a good idea. In fact, you could certainly do that. And in fact, the risk graph on the naked put and the covered call are so similar. And whether you're in a margin account or in a IRA type account where it's required that you have to have cash secured, like meaning you have to have all the capital, there's really no difference in a cash secured account where you have to actually have all the capital, because it ties up 100% of the capital to own the stock. In a margin requirement, you can buy the stock with 50% margin. And then when you go to write covered calls, you'll be collecting the premium on 50% of the margin. So your ROIs go up a little bit, but then you're paying margin maintenance fees. If you're writing the puts, you can probably get that, I think the minimum requirement's about 10%. And if you get portfolio margin, you can get that down like 5%. And so you don't have to have all your cash tied up to do the naked put. But a cash secured put, you have to have the cash tied up. So in this case, you got 116 plus 18, which puts us at what? 134. Okay. Thanks for doing the math for me, Sess. We're literally waiting for you guys to do the math so I didn't have to strain my brain doing basic arithmetic, but we got there from here. So that puts us out at 134. And the probability cone, when we looked at it, gave me a 136 ballpark. So if I can get out above the probability cone, and if I want higher probability, I go out above the 80% probability cone, and I get myself out above resistance, then the only way you really get called out is if you had an unexpected move in the market. At this point, though, the market's pricing in that expectation. So when I go look at the options chain, I go, okay, well, how far out can we go? Look at this covered calls out here. They're still pretty decent premium. So I get out past 136. So that means we'd be starting out here at like 137.50. And you'll notice you got some funny strike prices out there. And that's because of the stock split. So I would probably look at the 140, 145. And so I'd say, hey, that 140 is not a bad strike price. And let's take a look at what we would have there in the Greeks. So we can go look at probability out of the money in delta. That's one of my favorite layouts for covered calls. Probability of out of the money in delta. And when we go out and look at that delta, that 140 strike, your delta is 15. Now, earlier we mentioned that your typical covered call system's got a delta, 40 to 30. Which means, you're more neutral on the position. You're bullish, but you're not overly bullish, and your odds of getting called out are much higher. In this case, your delta is 15. The probability of it expiring out of the money at this point in time is 88.55%. So there's an 88.55% this option expires worthless. I'd be pretty cool with the 12% probability of getting called out. And when you look at the amount of premium you can collect, you could pull in $1.42 out of that. Okay, that's a decent little premium. Now, again, if you own 100 shares of the stock, you're only talking about $142. And I have a hard time getting excited about $142 personally. What does $142 mean to you? For some people, that's money they need to pay a bill, pay a credit card statement, go towards their car payment. That could be grocery budget. Depends on how much breathing room you have in your budget each month. For me, $140, that's like dinner out with my kids. So if my net delta, if I buy the stock, my delta is 100 because I buy 100 share increments. And if I sell the option with the delta of 15, my net delta is going to be 85. It's a Starbucks run. It's a Starbucks run every day of the month. For me, it's like, taking the wife and kids out to dinner type of thing. A month of tackle. Jimbo wins. Winner, winner, chicken dinner. That's actually a month and a half of tackle. And that's the best answer I have heard ever. That is a great answer. That's a month and a half of tackle. But look at it from a percentage point. Okay, so like if I buy Apple, and again, nobody gets super excited about dividends, but Apple's currently paying a 92-cent or 82-cent dividend. So 82-cent dividend on $115, $116 cost base, that's a little less than 1%. But you'll take it. You'll be glad to take it. Now, if I can get $142 off of $115 cost base, we're over 1% on the premium. Now, again, if you can get that 1% consistently, month in and month out, that compounds over time. And then again, you don't have to worry about how did Apple perform? Did it go up? Apple's the kind of thing that can certainly outperform that 8%, annual expectation that we expect from the market based off of the last 100 years worth of data. But if I could get, 3% quarterly or 3% annually on the dividend, plus an additional 1% a month or every 2 months on covered calls, I would already be at 9% annualized return, not counting any capital gains you got on the stock. It adds up. And if you let it work over time, it adds up a lot. And again, it's the type of thing that I'd feel pretty confident going out and writing that. And if you end up getting called out, that's not the worst thing that could happen to you, because you could always boomerang it. One of the cool things about the covered call strategy is if I go ahead and commit and buy the stock and I start writing the covered call, if the stock price goes down, I can just start rolling my calls down. And if I get really nervous about it, which I wouldn't do unless this thing broke probably 100, if it broke 100, 103, I'd probably start thinking, oh, Apple's in for a drop, and maybe I'd call the position, buy the protector put, sell the covered call to pay for it, and then endure the drop. But in the meantime, I don't mind selling that out of the money covered call. So now, in this case, I actually happen to have a collared position on Apple right at the moment. So what I'd be looking to do is uncollar it. But let me take those out of the equation, and we'll ignore those and just go add in a simulated trade, talk about buying the stock, picking it up. And again, just to make the math easy, I'm going to set it right at 116 even, just, shave a couple pennies just for making math easy, talking about it. And then again, if I decide to go out to November, I can go shorter term, but I'm happy to trade a little bit less, go out and sell that 140 strike, collect my $142 that I can get for splitting the bid-ask spread. And again, your risk profile, it'll cap out your gains. It would cap your gains if it did get called out above 140. You'd have, again, 80. You want to set your expiration calendar out to the same expiration date so you understand the probabilities. And then it's always nice to set a little price slice on the chart and go set it out at the strike price. And that gives you a slightly different math model. I'll delete the break-even point at this point in time. In fact, let me just do this. Let me go, I'll reset the slices, set this one out to the strike price, and I'm going to delete these other two, just so we can look at the probability model. Now, when I looked at the trade tab, you got a couple different math models that these tools you can, and of course you can do this for your poor boys too. You could buy the long-term leap instead of buying the stock and write, diagonals. And it's a very viable strategy, Ahmed. Absolutely. So you can adapt that same concept. And, for poor boys, I'd still probably try to sell that out of the money call, with the delta somewhere between maybe 25 and 15, but I'm going to go lower delta just to avoid, that probability of getting called out too quick. And if I can do that correctly, you'll get the capital gain from your long stock or your long call. Just make sure you're buying 6 months or more. That'd probably be the best way to go on those diagonals. I wouldn't buy any less than 4 months on a diagonal. 6 months or leaps would be best. And then, again, follow some rules. Now, here we've got, and I always like to kind of compare and contrast the different math models. So this methodology is giving me that 88% probability of expiring out of the money. The risk graph gives me, and let me make sure it's set right at 140 even. It's giving me an 87.21% model, so slight differentiation. And then I don't know if you guys have ever used this toolbox here, but have you ever switched your view on the risk profile to probability analysis? Have you ever used this one right here? And click on that. It gives you a little probability cone. And it can give you that October. You can go out and say, well, what are the probabilities of it by November 20th? This is where you're getting that same 87.2% model that it's going to be below 140, 12.80% probability. So just kind of point out, this is that probability cone, and it's based off of the current math inside your Black-Scholes model. And it basically goes out by date, October 2nd, 9th, 16th. It's going each expiration date. So I'm looking out here at the 20th because that's the contract we're looking at, and it's giving me that same 87.17 probability. And then if you understand the probability cone, that same probability cone that I had on the chart, again, I know a lot of you already know this, especially your tried and true tackle members, but that purple probability cone set on the 68% probability model. So again, it's telling me it's going to be below 141 is kind of where it's got that probability cone out for, 136, excuse me, for the November expiration date. So this red dotted line right here is November expiration. And that is where it's telling me it's likely to be between 136 and 95. And then you look at your risk profile in that light gray area on the chart. You want to set your expiration date to the expiration date on the options. This should be set to today's date. And then you can march this calendar up and down to kind of figure out how the time decay works. And that light gray area on the graph, that is your probability cone. And if I put my cursor out there on the top end of the graph, it's going to show you that 136 number. And if I put it down on the bottom of the light gray area, there's that 95 number. So you can use that probability. So this is selling the call just outside the probability model and saying, okay, yeah, just give me that cash. I'll keep it. And there's a small chance you get called out. But if you did, are you really going to feel bad? Like, you're going to get your capital gain. You're going to end up making a bunch of money on the stock. You're not going to feel bad if it rises for you. And worst case scenario, again, you get called out, then you can always go reallocate and get back in. You can roll your calls up if you need to. Okay. Again, not rocket science, but I think it's good information. So let's take a look. Let's find a different candidate and kind of run through the same model, just kind of repeat the process. Is that okay? So we kind of get the idea, go a little bit farther out. Now, actually, before we do that, I said we would talk about rolling up and down. If we talk about rolling up and down. So what do you do if the stock goes down? What do you do if the stock goes down? Panic? Rule of 72, right, Jimbo? So if you sit down and do the math, you pay off your shares in 8 years at a 9% return. That would get you there. That doesn't account for any capital gains you get. That doesn't account for, any other premiums you write. Every once in a while, I will double dip. Like, let's say you own 100 shares of Apple and you want to buy another 100 shares. Well, what if I start writing naked puts to buy it? And I own the stock, writing covered calls, plus I'm writing naked puts to buy more. And maybe I end up pulling 16% on the year. You make money on calls sold. You collect the premium. All the call is, by the way, if you aren't aware of this, if you're new to options, when I sell a covered call, all I'm doing is promising to sell the stock at 140. So if I own it at 116 and I promise to sell it at 140, they're going to pay me in advance for promising to sell it at 140. And we know people out there why would somebody buy that out of the money call option? Why would somebody buy that out of the money call option? Like, who's going to buy the 140 call? A speculator. Somebody who believes that the Apple price is going to go up. They believe it's going to go up a lot. And they're probably looking for cheap options and a high rate of return, get rich quick. But there's an 88% probability that the option they're buying expires worthless. So in essence, we're selling a lottery ticket. And it's a newbie. A newbie is going to be buying that. So we're selling a lottery ticket, giving a speculator some hope. If the stock price rises, they may make some money and we could end up giving up our shares to them. There's a possibility whoever bought that could turn around and sell it back to the market. And, we can buy back our contract at any time. Now, if the stock starts to go down, if the stock price starts to go down, let me take the stock out of the equation and show you what happens to the call. So let's imagine for a moment that instead of rising up and continuing to go up, that Apple's stock price starts to drop. And we see red candles coming in and it starts to go down. Now, again, if my model here is like, okay, I don't mind owning Apple long term, and we start seeing red candles coming in, I'm really not going to panic here unless it takes out support. And this comes down to, I think, investor temperament. You can use stop losses, but if you're the type of person who wants to own Apple long term, you probably need to have a longer term investor's temperament to go along with it. And probably the best way to think about owning an asset and writing covered calls on it, it'd be like owning a home and renting it out or leasing it out. The value of the property can go up and down, but you can collect the rent check every month. You can check that, collect that lease payment every month. In fact, I would really compare the covered call to a real estate lease option, where you can own the asset and then give somebody an option to buy it at 140 from you, and you give them a term of 50 days. And if it goes above 140 in the next 50 days, they'll take it from you. If it starts to go down, what happens is you do start to lose on the stock, but you will end up being able to realize your gains on the short call quicker. And what I would look to do is I would start rolling the 140 call down. So I'd start rolling the 140 call down, 140 call down. What's going to happen is if the stock price starts to drop, this probability cone starts to drop with it. And it, the high watermarks out there will start coming lower. So you can simply roll the calls down. Now, if Apple were to come down and break the 103 support, maybe that 100 zone, and the market sentiment's obviously bearish, that's when I would probably be looking to, collar the position or roll the calls in the money to defend it. And so, prices go down instead of up. The answer is relatively simple. You start rolling down and out. You start rolling down and out. Now, down means lower strike price. Out means further in time. Down means lower strike price. Out means further in time. If the stock price is going down, you'll have to buy back the short call. If it's going down, you're buying back your short call at a profit. You will be losing money on the initial stock price, like you will be feeling that. But then you go sell another option, you bring in another credit, you lower your initial cost base. And if you need to get defensive with it, you can roll all the way down to in the money options. And a lot of you who have hung out with me in the lounge or in the coach's show and whatnot, you've all probably seen me show you how to use covered calls for defense. So here we're kind of using covered calls for cash flow, high probability cash flow, way out of the money. But one of the things I love about covered calls is if the market starts tanking, I can start rolling them into the money. Now, when do you do the rolling? Really, I have a couple good rules for you, for Majid. Technical price level. It breaks a key support zone. That's a good time to roll. If the option starts dropping to the point where, let's say that, okay, let's just do some real basic forecasting here. If the stock prices, let's say tomorrow, the market sentiment shifts, everything starts selling again, insert whatever headline logic they're going to give you for why they're selling. How many days do you think it would take to get down to 104 support where it could break? Yeah, protective right's the same thing, Grant. A protective call right where you would consider rolling in the money. But how many days do you think it would take to head down and get to that support zone based off of just kind of the price action you see here? It'd probably take a week or so, maybe a couple big days down. Minimum 2-3 days, probably a week. So if march the calendar forward 1 week. Let's just say it goes forward from today. Oh man, guys, I'm just barely figuring out tomorrow's October. That's crazy talk. We get to October 7th, for example, a week's gone by. And the stock price has dropped to 104. You sold the option for 142. You'd have about $120 profit. You'd only have $20 of time decay left. You'd only have $120. You'd only have $20 in time decay left. You would have collected 120 of that. So you sold it for 142. You're buying it back for 120. You're buying it back for $20. Does that make sense? You sold it for 142. You're buying it back for $20. Now you are down on the stock. You're feeling some pain on the stock. And if you have to have that investor temperament, so you're not panicking, because is Apple going out of business? Are they going to tank indefinitely? No. Apple stock price may drop short term. And of course, you can always do credit spreads, Ahmed. You can always do that. But you can kind of apply the same principles. So you roll the call down, and what you would do is you'd go buy it back. And we can theorize that. We can basically go to a theoretical price column. And this is a little bit more advanced. It's trying to think moves ahead like you do in chess. And you're saying, okay, well, look, if I get this calendar set up to October 7th, and we're talking about the stock price dropping 11 points, minus 11 points. The 140 call, theoretical, there's the theoretical price right here. So this is the Theo price column. These are the little adjustments we put in right there, Theo price. And this is something you can just look at on your option chain. You got theoretical price parameters, you put on a guess date, a guesstimated date, a guesstimated stock price drop. And you could factor in volatility, but I'm just going to leave that out because I don't know what volatility is going to do. Probably rises. But theoretically, you'd be able to buy that call back for 24 cents. So you're selling it today for 142 at the mark, and you're able to buy it back for 24 cents. So you're pocketing, basically you're pocketing $120 ballpark. Then you roll down to a lower strike price. You can follow a similar delta rule. Maybe you roll down to a delta of 15.25. You go pick a new strike price and you bring in another 140, 200, $200, somewhere in that ballpark. Make sense? Okay. You can roll it down. I wouldn't panic on that unless it broke a key support zone. If it breaks a key support zone, then I'm starting to feel more bearish sentiment. And I wouldn't really panic unless I also saw the rest of the market, like, the NASDAQ breaking support, the S&P breaking support, bearish fear gripping the market, in which case, if you're worried about the quick drop in the market, you can roll in the money, and, or you can collar the trade where you roll a call down to maybe at the money or near the money. Sell a call, collect the premium, take that premium you collect and turn around and buy a protected put. And you can literally lock down your position 100%. So Scott puts in a comment here. For me, part of the equation is how long do I have left in the option? If it could recover, and can I juice more? Yeah, I agree with you. For me, it's a question of efficiency. Like if it drops and I've collected 140, 120 bucks out of the premium in a week because the market dropped, and I have to sit around and wait for another 40 days for the rest of the 20 bucks to come in, I'm not going to sit and wait 40 days for 20 bucks. I'm going to roll the option and try to juice it up again, create some more time decay, create more theta, and bring in another premium. And I would do that even if it just got, if I just happened to get that. Jimbo, didn't think, I don't know what your kind of English language you're using here, Jimbo. Didn't thinks get spooky last week on Apple things and overall market. 80% max profit's a good rule, Randy. I like that rule. That's a great rule for it. When you get 80% max profit, roll the option out, collect more premium. If you want to, you can roll down. You don't have to roll down. You can just roll out. You can roll down and not out. You can roll down and stay in November. But you can roll down and out when necessary. And if you need to get defensive, you can roll down in the money. You can roll down, to a lower strike. Like I could roll down to a 90 and hedge against a drop all the way to the next support zone. And if you go look at how much intrinsic value there is in like the November 90s, there's enough intrinsic value in a $90 strike right now. They've got $26 worth of intrinsic value. And you could, I wouldn't be doing that now, but there's enough premium to cover you all the way down. So, as that is, you'll get more extrinsic value as it gets closer to the strike price. But that's one of the things you can do is you can always roll in the money if you need to and have a really high delta in the money call. Again, worst case scenario, you get called out, but there's almost always enough premium in the intrinsic value plus whatever extrinsic value you get to cover your asset down. And again, if you go in the money, you might get called out, but worst case scenario, you get called out, you keep your capital and you turn around and sell a put to reacquire it. Now, great. This is a great question, Sess. Look, if you're a month out, you might want to sell before earnings. This is a great comment, Sess, and very, very insightful. I went out past earnings. And one of the reasons you're getting a really good premium out past earnings is because it's past earnings. You could take, oh man, they got earnings on the 29th of the month. And you could take all the same rules and say, you know what? I don't want to deal with earnings. And usually it's a wise idea to buy it back if you don't want to, and I wouldn't mind leaving a covered call on before earnings, but I'd probably go and say, hey, maybe I should sell those 23rd of October and go find an option with a delta of 15 or so, 86% probability, 129 strike price, and collect 80, 85, 87 cents, somewhere in that ballpark. And, it's less, it's, not quite half, it's a little bit more than half the money. And you can go look at that expiration date and answer all the same questions that we looked at before. Say, okay, well, hey, if I'm going to use October 20, what was it? October 23rd. I can go put my little cursor on October 23rd and say, okay, hey, on the 23rd, it's going to be somewhere around 130 strike with the 80% probability model, 134. And if I'm following a, October 23rd delta rule, and again, probability delta, that puts you at about 129, 130 ballpark, delta 15. So you're right there in that ballpark. So you can do the shorter term option, not worry about the earnings. Love that question. That's a great question, Sess. That tells me that you have had a educated mind. Well done. Anil asks, what's a good time frame that you recommend to start selling calls 4 weeks out? I didn't think you said heck yeah, Scott. I thought you said something a lot stronger. My bad. What's a good time frame that you recommend to start selling calls? I think 4 to 6. My general rule on that, Anil, is 4 to 8 weeks. 4 to 8 weeks. You can go less. Some traders like to sit and write short-term covered calls. I've never really liked short-term covered calls. They require me to be too hyperactive with my trade management. My sweet spot is 6 weeks. Given my druthers, I love a 6-week covered call. That's kind of what I like as far as the models I've used and all the testing I've done and trading experience over the years. 30 days is fine. 60 days is on the high end. 45 days is my sweet spot. So I always like that. And again, you can kind of, the goal is to generate regular income, regular cash flow, still own the asset, collect dividends, and maybe take advantage of some of the upside capital gains. Every once in a while you get called out. That happens. You can consistently lower your cost base. If you don't want to get called back, you just buy your calls back. And you will take a drawdown on the calls, but you will have more than made money on the stock capital gain. So all's buying the call, all's, that's not really a word. All that buying the short calls back would do is detract from your capital gain on the stock. It would be a bit of a bummer, but you would actually still be winning on the stock more than you would ever be losing on the call. That makes sense? Okay. Hey, we got a really good group watching tonight. We got a lot of people here, by the way. A lot of people. Give it that, smash that like button if you had fun tonight. And if you're new to us, I know a lot of you all here are pro tackle members. If you're team tackle, please type in the chat hashtag team tackle. But if you're new to us and you enjoyed learning, we want to